Hello, I'm Bernard Hickey from interest.co.nz and welcome to an economic weather report on inflation. We've got some figures out today which show that consumer price inflation rose 5.1% in the September quarter of this year versus the same quarter a year ago. This is an 18-year high for inflation in New Zealand and in normal times would cause a panic. But this is actually in line with expectations. The key issue here, this is looking in the rear vision mirror. September quarter finished quite a while ago, and now with the global economy heading for recession and with commodity prices falling very sharply, including the price of oil, wheat, various other animal feeds, this is going to drive inflation lower right around the world, but also in New Zealand. The key issue now is, what does this mean for interest rates? This leaves the Reserve Bank with plenty of room to cut the official cash rate by 100 basis points, a full 1%, on Thursday from 7.5% to 6.5%. This result on inflation was in line with market expectations, so it shouldn't change the view too much on what's going to happen to interest rates. And most people are now saying 100 basis points will be the cut. People are also saying that interest rates are likely to keep falling, this is the official cash rate, to around 4.5% to 5% by early next year. What does that mean if you're looking to roll over your term deposit or move into a new mortgage? Well, term deposit rates are likely to keep falling fast. So if you get a chance to lock in and you want to get yourself a decent rate, I'd move pretty quickly. Mortgage rates, well, variable mortgage rates are falling, but they're still quite a bit higher than fixed rates. Fixed rates are likely to fall, maybe not as fast as term deposit rates, because funding costs on this international money that the banks have borrowed are still quite high. So on the whole, it still looks better to have a look at the 1 and 2 year mortgage rates rather than wait for the variable mortgage rates to fall, although in a year or two's time the situation might be different. Key thing though nowadays is not so much the cost, it's whether you can actually get it, particularly if you're taking out a new mortgage. The banks are being very careful these days on how much they lend, particularly high loan-to-value ratio mortgages. I'm Bernard Hickey. That was a special economic weather report on inflation and interest rates.